Welcome to Wage Zero, where I share my knowledge about building wealth and making work optional. Today I'm going to analyze Microsoft since I believe it's an opportunity right now. And I've been eager to add one of these big tech companies to my portfolio. So let's take a look. I'm going to use this tool to invest. Is the one I like the most right now. So let's take a look at the company. Yeah, here we have some fair value, quality, dividends, value indicators. I will not rely too much of them, but just to give a brief look, we can see that it's a very high quality company, and the dividend is small, but is well funded and increasing in a fast pace. So it's a more DGI strategy. If first I'm going to look at quality. This is what I first look. Here it says excellent. Well, I think here we can see the reason right away, right? So we have these net margins, crazy margins, and if we look at them over time, they are sustainable and they are also increasing, right? So from 2019 it was 31%, and now we are at 45%. Of operating margin. Also, the net margin is increasing. Margins are amazing and they are increasing, so this is a very good sign. Also, look at this return of equity. this is quite high. Also, return of invested capital 25%. These are just huge returns. You can see that this is a quality company indeed. Also, debt is quite low. Yeah, this looks amazing. I'm not surprised that it has this very high rank here, 99. So I completely agree with this assessment that the tool does. Okay, now if we look at the dividend, it says excellent. However, the yield is quite low, it's not even 1%. One thing to note, if we see the history, it seems that, so this is the yield over time, and during the last approximately 6 years, whenever this yield approaches about 1% or a bit beyond 1%, this seems to be the bottom of the stock. Something to note. So the yield is low. It's tough for a dividend investor to have this kind of yield, right? Because if you add taxes, it's even lower. So you are not buying this stock because of the dividend, even though the growth is quite good, 10%. We buy this company because it's a high-tech, high-quality compounder company, not because of the dividend. I think it has a place in every portfolio, even if you go full for dividends. So let's take a look at value. This is more interesting stuff. If we look at the forward PE, is 21 times, and this is very important, very interesting, because if we look at the PE over time, so usually around 21 times is the lowest in the last decade. It was here in June, then 22, 24, 23, 24, 6, 25. This usually bottoms around 22, 25 is the bottom. This is the last decade. And to see lower values than 21, we have to go back to 2015. So 1 decade, 10 years. So I think this is very interesting valuation for Microsoft, and it's worth to pay attention even if you are hesitant about the dividend. If we look at the EV EBITDA is more or less the same. So we are around 13 times, and here the bottom is 13, 14, 15, 16, around here maybe 2018, but lower than 30 we have to go, and 2016 11 times. So also this ratio is quite low, is the lowest of the last 10 years. So it's a very interesting valuation for Microsoft. Okay, let's go to the meat and potatoes. We take a look at the financial data. And first, I'm going to see only revenue and operating cash flow over the years, last 10, plus some predictions for the next 1 year and a half. So this is what I like to see. Sales are going up at a 14%, good, very good, and operating cash flow even higher, right? Faster, 18%. So this is good. This is quite good. If you can compound around 15% a year, I will sign it. I think this is a good company to have in the portfolio, just saying these numbers. Okay, let's take a deeper look. So let's see about the last 3 years or so. And let's take a look at everything, excluding the total revenue. Okay, so what do we see here? Let's take a look at this year, 2023, to see how they use money. So they have some almost 90 billions in operating cash flow. They have almost 30 billions in capex, so they spend a lot of capex. After that, we have 60 billions in free cash flow. We make some money with some investing activities. We don't acquire anything almost, and we purchase some own shares, so 20 billions for that. Dividends around other 20 billions, so 60 minus 20 minus 20, another 20 left. We pay some debt, so this is quite good, and total net debt is negative, so they have cash, 30 billions in cash. They don't have debt. This is amazing. 2023 amazing year. So if we look at 2024, I see that we have more capex, probably because investing of AI in AI. But we have a huge acquisition here. I think this was Activision Blizzard acquisition, and they spent more money than the one they had, so they have to take some debt, 22 billions. Okay, that's fair. Sometimes you want to acquire a business to make more profit and you need some debt. This debt is quite low if you compare it with the free cash flows as peanuts. They cannot afford it, right? Now, last year, 2023, they keep increasing the capex, quite an amount of capex, and then this is more or less same. Almost no acquisitions, some buybacks, some dividends, and here they paid some debt, so a little bit more less debt, sorry. So still fine, but this capex is increasing at a fast rate, and if we see the prediction for 2026, here the capex just go berserk. This is the double the capex, and they are also increasing sales but raising the cash flow because of those investments in data centers, AI. So I guess that's why the market is punishing this company, right? Because this capex going wild, and this is probably clear if we look into the future of more years. So if I extend into 2013, here we see that they predict, or at least the analyst, they expect revenue, well, operating cash flow increasing a lot. So from 2027, which has we have 214 billions, and it's going to almost double by 2030. Okay, that's expecting a quite huge growth, but this is also accompanied by a huge capex. This keeps going wild. So it's not going to double like from 2025 to 2026, so it's decelerating in relative terms, but it's still a huge capex that they are committing. Good thing is that they predict, I don't know how reliable is this, but the debt is going to go lower, and they are going to be cash positive again. We will see about that, but this is, I think, the problem. So it's an amazing company. They have tons of free cash flow. They can afford to make these capex investments in AI, but the history they are selling us is, hey, we are going to spend a lot of capital in data centers, but we are going to make a lot of money out of it, even more than before. But you have to believe them, right? How are they going to monetize these data centers, this AI activity, these cloud services, agents, and so on? So I think the market is being more cautious about how much money they are going to make, because these are huge claims, huge expectations, and if something goes wrong, then stock is going to suffer. Is already suffering. Yeah, to me, I think they can sustain these capex. Maybe expectations are a bit high, but you never know. I think this AI industry is a winner takes most kind of thing. So only a few players are going to make money out of them. And probably the ones that are going to make money are the ones that are investing into capex, like Microsoft. So yeah, I think overall it should be fine. Just be a little bit cautious with this kind of growth, because yeah, if something goes wrong, then we as investors, we are going to suffer the consequences. But overall, it's a great company. I mean, these margins, this return of capital, low debt, I think they can withstand every situation. It's not like other companies that they are swimming in debt. Microsoft can just survive with that kind of cash flow, and they have a moat. I think it's in a very interesting valuation here. So it's something to keep an eye. These 20s in P ratio, you don't see them often at Microsoft. We are valuing Microsoft like we were in 2015. So to me, this is an opportunity that depends on you, and everyone should take a decision based on your portfolio composition, your goals. But I think you really have. I'm going to think really hard about this one, at least. Okay. So thanks for watching, and see you in the next video.